Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking Aurizon Holdings, ASX code AZJ. Good morning, Elio.
Yeah, good morning, Phil. And I can definitely think about this stock as when is the train going to pull out of the station in regards to this one, because it's been coming for a long time. Investors have been looking at it, no doubt, taking a bit of a nibble, but they keep being disappointed. And yeah, we're just going to talk about the numbers and what are the drivers for this business in our podcast today.
Yeah, leaving the station and on track to describe the numbers going forward. So, yeah, we'll get rid of the tortured analogies and just tell us about this company so people will understand. But I just wanted to say that we're covering this particular company because we had a question from a listener. Thanks for getting in touch, Stuart. But before we cover Stuart's question, tell us about Aurizon and what they do.
Well, look, quite simply, they've just got rail tracks and trains, and that's what they do. And they've basically, the majority of their profits and their revenue come from a 2,600 plus kilometre rail network that they've got streaming across Australia. And look, they're the largest coal rail network in the country. They connect some 40 mines to basically what is 5 export terminals, I think. There's 3 ports, although that said, they're currently in the process of trying to get the ACCC to see them acquire the Flinders Logistics port for some $25 to $35 million. But suffice to say, they're a boring business. They don't really do much other than haul stuff. The real kicker here, and I think where this gets interesting, is that you've got your coal business, which, to be quite frank, is a highly regulated business. I mean, for investors that are considering the stock, you basically need to understand how the Central Queensland coal network actually works and how their mandated revenue stream is attached. And look, it's been quite good for them in the last 6 months, but, suffice to say, you do need to understand how they accept royalties and payments and how that price is actually struck there in that regard, especially important as it is the majority of their profits for the moment. But then there's the other part of their business, which is the bulk business, which is basically moving everything other than coal across the network and beyond. And then they've got containerized freight as well. So I should also mention that, but that is very much a more emerging sort of business. So, I mean, look, without boring everyone to snores in regards to the company, because there really isn't all that much to say about it, because the trains don't move all that quickly, but they are exceptionally heavy, of course. But look, they've had a pretty good 6 months and 12 months in general, but unfortunately its share price really is subject to the price taker syndrome. And I know I've talked about this before, Phil, on the podcast, where they don't have all that much control with regards to the price they can charge. And as a result, that they are subject to the rising cost of doing everything. And some of their growth avenues probably haven't taken speed as a company may have hoped, particularly given that debt balance. I'm sure we'll talk about that in a moment too. But yeah, look, basically hauling stuff. Coal is the predominant business, but then there's other stuff. And really that's the growth engine and where investors will hope there is some silver lining in this story.
What do you mean by mandated income stream?
Basically, their primary source of revenue comes what is known from the Queensland Competition Authority, basically. And there's negotiations that the company has to enter with the authority in regards to how much they can actually charge for haulage on their network. So it's not an open market. They can't just simply charge whatever they would like to. They were lifted, of course, as you would expect in the last 6 months in regards to the cost of that haulage. But it is incredibly important because without these negotiations and without setting that base price, they're not going to be able to generate any revenue in effect. And because it does contribute so much in regards to its profitability, investors need to be aware of these discussions when they do occur, because that process does have that significant impact on the company. So, yes, a little bit, shall I put this, convoluted to a degree, but it's quite simplistic when you break it down to a basic level. Effectively, they need government authority to mandate the money they can charge in regards to the haulage over their coal network. And because coal is such a large export from Australia, and still remains to be, despite the fact that coal stocks have been on the nose, you definitely need to appreciate and understand how that negotiation process works, particularly with the Queensland Competition Authority, because effectively, without their go-ahead, they can't really increase prices.
So you mentioned the pressure that the share price has been under recently. I think they're on a 12-year low or something like that at the moment. And this kind of relates to Stuart's question, who was asking about why the share price has been under pressure. But they're on track to having a very weak financial year 2025. Tell us about those forward estimates.
Yeah, look, this is the really interesting bit, isn't it? Because really, when you look at the company from a total revenue perspective, there's this steady little increase that's been going for quite some time. I mean, since 2019 to 2024, it's had a CAGR average of 5 years of 5.76%. And forecast-wise, as you allude to, Phil, they're expected to increase both in 2025 and 2026. It's also important I remind everyone that we are looking at the latest financials here in regards to AZJ, to which they had a big sell-off, and no doubt was the motivation, as it were, in regards to the question. Now, of course, that then, once you get that sales revenue and the amount of money they get, then how they control that money that they receive is obviously under possible question. In 2023, they did have some struggles, as it were, but then that rebounded quite strongly in 2024, and that's expected to continue to rebound in 2025 and 2026. Now, the company on the back of that was able to increase its cash flow. The amount of operating cash flow per share actually rose over the period and has done for the last 5 years consistently, as did the free cash flow per share, and that basically takes our capital expenditure, which, to be fair, is lower than what the operating cash flow level is, but it's still positive. So that's a win. And then you go look at the dividends, and notwithstanding the big cut to dividends that had occurred, particularly on the drop of profitability, they did return to a rising trend in this most recent period. And they are expected to mirror what has occurred in regards to this latest period in 2025 and 2026. I think the forward dividend yield is something like 5.9%, Phil. But I think the big question is, why would you necessarily have that drop? And it is about the estimates. And we need to remember here that this company is highly indebted. Okay, it has a lot of money that it owes. And unlike Transurban and a few of those other more complex financial instruments which are built out there, I mean, I know they've got toll roads, but they can be quite manipulated in regards to their accounts. But Aurizon less so. But unfortunately, when you look at their accounts, they do carry a lot of debt. And I mean, you need to also consider the fact that, they've basically made acquisitions recently, which is a little bit concerning. The bulk business, if you look down to the minutiae of the detail, really didn't do all that much. And unfortunately, whilst, a good dividend's okay, operationally, you go and buy one rail, you then go and spend all this money. And whilst you might have the real asset, they're still yet to see really rubber hit the road, in a way, with regards to that bulk strategy, because they really need that to diversify their earnings away from coal, as it were, in their profitability. So the analyst fraternity out there still puts a lot of emphasis on that, because obviously it makes up the vast majority of its income. Its outlook statement with regards to the bulk business was disappointing, because they've taken on quite a bit of debt in order to finance that exposure out, and it's not quite getting the traction that they would expect yet. So this is really just a case of it just disappointed. It didn't hit the mark in regards to operationally what everyone expects of the company and what they expect them to actually turn around. So if you're going to maintain the faith in regards to Aurizon, then you're probably going to have to look past this report, unfortunately. That said, if you've done that for the last 12 years and you're still waiting for this thing to turn around, you're probably going to be waiting a little bit more. Unfortunately, it's just a sick business, and traditionally companies where their revenue stream is heavily mandated by government are a bit of a warning and a bit of a red flag. But then again, there's always hope, right? And possibly AZJ may very well do that, even though unfortunately they disappointed investors this latest time around.
So getting back to Stuart's question, that he could see that the share price tanked on the 12th of August when the buyback was general knowledge. And he seems to be relating the share price decline with the buyback. And he asked, how can one identify if the buyback is a positive or a negative? So what's going on in this case, Elio?
Look, it's a really good question, actually, because a bit perplexed in the sense that a share buyback's got to be good, right? I mean, it's $150 million worth of the company's cash flow, and they did point to their rising operating or free cash flow, in regards to their ability to be able to pay this back. And you can basically do it in two ways. You can either increase the dividend, and look, the company's already got a forecast dividend of 5.9%. It goes ex actually on the 26th of August. So unfortunately, many people may very well miss out on that dividend. So from a dividend perspective, there's people that are holding the candle in regards to hoping that this will turn around. But then, yes, they could have gone out and paid a higher dividend, but they did the buyback.
But generally, a buyback is a positive thing because it's reducing the number of shares on issue. There's less slices of the pizza to go around, isn't there?
Yeah, very much correct. I mean, and this company has a history of reducing its share on issues. In fact, it's one of the very rare stocks on the ASX where over the last 5 years, there's actually been a 2% decline, CAGR, average as it were, in regards to the amount of shares on issue. So in effect, you're buying more of the company today than what you were, say, 5 years ago. And that data is available also within Stockopedia. So a share buyback, as you say, just takes shares off the table and therefore, in theory, would make a company more valuable. However, we're talking about a company whom, even after the big price decline and the stability that we've seen since then, has a market capitalization of $6.2 billion. Therefore, $150 million is probably not going to cause much of a dent. I think it's around 2%. Again, in regards to the percentage of the business. So it's really not going to move the dial, as it were. And then there's questions in regards to, well, really, why did you do that when you probably should have just spent the $150 million in paying down debt and bringing that, the Z2 Altman score that we have there, right? We have it as 1.24, but possibly it'd be a higher score, which would obviously then put it in the cautious zone, one would assume. But again, it's not too significant. And remember, with a buyback, they don't necessarily have to buy it unless they feel that there's value in the stock. And quite frankly, being at 12-year lows, I think it's a good level to be buying right now if you believe in the story and the long-term trajectory. But again, I think there's a bit of time before that necessarily comes to fruition, particularly in a capital-intensive business like Aurizon, whereby there's mandated revenue, there's a hell of a lot of spending. They now need regulatory approval to keep them happy. The outlook wasn't as good as what a lot of people had hoped. And unfortunately, it just disappointed. And its price reflected that more than the actual good dividend and buyback that the listener was questioning.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. And that's something about capital management, isn't it? That a buyback is one of the levers that a company can pull in terms of managing its capital. As you say, they could reduce debt, they could add to the dividend, they can do a buyback. Are there any other ways that they could use that capital?
No, no, Dan, you've pretty much covered them all, Phil. I mean, in effect, it's a good problem to have. I mean, you want your companies to have the ability to either pay dividends, which we all receive in our pocket, and a company will do that because by admission, what it's saying is that effectively it can't really do much more with the income, so it basically pays that out to investors, and here it's better in your pocket than ours, and therefore go for your life, try to figure out somewhere better that you can invest it. You could decide to buy back shares because, as you say, the price is so ridiculously cheap, as it were, that the best use of those funds are going to be, as decided by the board, of course, whom we elect as part of the process of owning a share. They decide that, no, these are ridiculously cheap and therefore we're going to buy those shares at the moment, or they can keep them as retained profits to basically go out and acquire someone else or fund other business operations. Because let's face it, right, there's three sources of finance for a company. One is their retained profits. And obviously that's a good place to tap if you need that. It's a concept we discuss quite frequently, and that's good. That's where you want to be. You can also raise capital from shareholders. Now, when you do that, what you're doing is you're saying, we're going to find the next big thing, and therefore we want to raise money in order to do that. And unfortunately, there's too many hit and hopes on the ASX, a very long tail, as it were, in regards to a number of these companies who are we'll call them gunners, going to discover the next big thing and therefore tap, investors for that money. And no, you can't claim it back for its philanthropic efforts, unfortunately. Once it's gone, it's out there. But nonetheless, that's a way it can source its funding. It's expensive, though, because it's timely. You got to manage them, or manage shareholders, as it were, and there's a costly process in regards to doing that. And the third way, and the cheapest way, is to actually do it by debt. Only got to find one counterparty, as it were. In regards to AZJ, they obviously go to open market, command very big bonds that need to be refinanced, and we know what's been happening with interest rates domestically, even though internationally they've been coming down. But obviously the risk is if you don't pay, then basically you don't play. They can shut you down. But if you can carry that risk because you're a cash-rich business, which someone like an Aurizon actually is, then that does help. Doesn't mean you can't still disappoint, though. And as analysts, that's what we're trying to do 24/7. That's what justifies our wages. We're trying to not only look at a business today, but we're trying to gauge their expectations moving forward. And in regards to an Aurizon, it was just, pictured to do better than what it actually was. And when you read the minutiae of that detail, that bulk business continues to be a worry. So, I suppose the headline looked great, buyback, got to love that. But in practical reality, it's not as important as the business is operationally.
I can sense your analyst disappointment right all the way here from Sydney, from Melbourne.
Well, look, to be frank, in regards to Aurizon, I've sort of got a sore foot after kicking him for so long. So eventually I'm going to have to rest that, and I think that'll come. They did put a lot of their emphasis in regards to the bulk strategy, and rightly so, because really that's where they do actually control some of the levers, and their container freight as well, I should add that. But this latest period, again, they just missed the mark. And what's the definition of insanity? Doing the same thing, expecting a different outcome. Well, they're trying to change it up, but unfortunately it's not necessarily hitting the huskings, as it were, just right now. Although, the hope is that one day they will. To be frank, I don't think the buyback really changes that narrative much at all.
So I just quickly wanted to discuss the stock rank style, which is one of the measures that Stockopedia applies. This one's described as a contrarian company. And what does contrarian mean, and why does it apply to Aurizon?
Okay, so contrarian, in effect, is a definition relative to its score. So it's obviously a high-quality company in regards to, it's rated as 83, notwithstanding it has declined a little bit.
And not bad value either.
No, not bad value either, a rating of 81. So that's the contrarian bit. So we're talking about a good quality business that represents good value. But unfortunately, the momentum is down. I mean, we talked about the price, which has fallen below $3.40. It wasn't all that long ago in regards to, just a few months ago, actually, the stock was trading at $4. We've seen a raft of analyst downgrades as well in the latest period, which have also contributed to the stock falling on a momentum perspective. So that big hit really sees the contrarian perspective. So if you were going into this business, you're looking at a quality company, you're looking at a stock that represents value, but unfortunately the market doesn't like it. And so you're going to have to stand against the tide, as it were, to take a position in this business, because that's really what you're doing in regards to AZJ, and hence why we've rated it as a contrarian. So it's nothing scientific, or I suppose further more complex than that, just that whenever the share price doesn't reflect the fundamentals, you're going to have these periods of disconnect, and therefore, as a result, in regards to AZJ, they've got that. But again, when you always scratch beneath the surface, you'll always find an underlying story as well. And as I said, that rising debt balance, which actually, to be fair, did come down a little bit in this latest period that they did declare, but it is still quite large. That large debt balance, if they can furthermore continue to focus on reducing that, that'll go a long way to shoring up this business. But again, the container freight and bulk side of things, they're going to have to address those and grow those in order to win the confidence of investors back.
It's really important for investors to understand this because so many inexperienced investors, and I've been guilty of this myself, is you look at a company and you look at the share price and you go, oh, that's gone down a lot. Maybe it's time to buy, without actually understanding the reasons and the underlying numbers that are causing this decline. Because there's a lot of very smart people like yourself looking at these companies and running the tape measure over them.
Well, it's not just me. It's every man and his dog, to be quite frank. So the prices are great. I don't use it in regards to, identifying is this down, is this up, et cetera, et cetera. What you do is it often gives you a bit of an insight into the soul of a company. And what you then do is it begins a journey in regards to further research and understanding, because then you have to decide, are you correct and everyone else is wrong, or is everyone else right and you're wrong? So rather than using it as an absolute measure, I mean, when you look at a share price decline like this, there's obviously something going on. And when you see the share price not doing much, then again, you need to do your research to learn about that. And there is anchor ship bias that we all have. I mean, we see a stock that was, say, $10, it's now $5, and we think, wow, it must be cheap. Relative to what was perceived that the business would be back when it was $10 relative to now $5, there's always been a change in regards to that. And it's important to understand that change, because the market does price a business and all its future cash flows to a present value today. It's done that infinitum. That's, again, what analysts do. And they can, juggle and dance around a spreadsheet as elegantly as anyone. And the share price will tend to move between over-optimism and over-pessimism. And the reality is that the price should be somewhere in between. And therefore, as DIY investors, we try to find those particular moments and those disconnects, as it were, in order to profit from them ourselves. Because by the time we hear about something, Phil, that's you and I, it's probably going to be already too late. There was a chap by the name of Joseph Stiglitz who in 2001, I think it was, won a Nobel Prize in economics for this particular theory, making that mathematically possible. But again, the stick your head out of the window economics that I like to follow, we knew that some people get better information than others in regards to some of these companies. And yes, we're going to be the last in line to actually hear about it. So I'm only talking about yesterday's news, as it were. And as perplexing as it is, the share market is very generous in dishing out lessons. It's unfortunate that we just fail to listen to them. That's our problem. And Aurizon's been one of those lessons for quite some time. So yes, long-suffering shareholders, one could argue, the business is bigger today than what it was, say, 5-10 years ago, but its share price really hasn't moved all that much. So the value investors, I'm sure, will be champing at the bit. But I tell you what, if it can't get its outlook right, it's going to languish down here for quite some time.
Some great lessons there, Elio. And Stuart, I hope you got something out of that as well, as I definitely did talking to you. Elio D'Amato, thanks very much for joining me today.
Thanks, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.